Welcome, everyone, to today's Explainer. If you've been tracking this massive artificial intelligence gold rush, you've probably noticed that the headlines are basically just dominated by the big software giants and chip designers. But today, we are looking at the ultimate picks and shovels play of the entire AI supercycle. We're talking about Applied Materials. We're going to break down exactly how this company serves as the literal foundation for the whole semiconductor industry. We'll dig into their seriously unprecedented financial performance recently, and then we'll objectively weigh their valuation against the very real risks they're facing right now. Okay, let's map out our journey for today. We're breaking this down into 5 parts, starting with the AI supercycle foundation, moving into record earnings and margins, then decoding the valuation models, taking a hard look at the bear case risks, and wrapping up with environmental and climate impact. All right, Section 1. The AI Supercycle Foundation. Let's set the stage by looking at the massive total addressable market driving all of this. What's really fascinating here is just the sheer, staggering scale of the exploding global demand for AI hardware. The hardware segment is just expanding so rapidly year over year. And here's how the value chain actually works in the real world. Your absolute end markets, think Meta, Google, Microsoft, OpenAI, they need immense computing power to train their models, right? So they go to chip makers like NVIDIA and AMD to design these highly specialized chips. But those chip makers don't just conjure chips out of thin air. They rely completely on the incredibly complex machines manufactured by Applied Materials to physically build them. To truly grasp why this company is so crucial, we've got to understand exactly what they do. Grounding this abstract AI boom into physical manufacturing reality, there's a key process called deposition. Basically, this is the act of depositing ultra-thin, literally microscopic layers of material onto a silicon wafer. Those layers are later carved out to build the actual semiconductor chip. Applied Materials basically excels at materials engineering. They are manipulating matter at an atomic level to make these incredibly complex, next-gen AI chip architectures even possible. And this is what creates their massive structural moat across the wafer fabrication process. Applied Materials isn't just a casual participant here. They are the dominant, undisputed #1 player in deposition. They are also #1 in CMP, chemical mechanical planarization, which is essentially polishing each of those microscopic layers to absolute perfection. Oh, and they hold the #2 spot in etching, right behind Lam Research, and they're a rising force in advanced packaging. Think about it. When you control the most critical steps of the chip fabrication process, you aren't just important, you're indispensable. Moving on to Section 2, record earnings and margins. Let's shift our focus to see exactly how this market dominance is translating into their recent, unprecedented financial performance. Okay, the absolute crucial point here is this number, 50%. In Q2 of fiscal year 2026, Applied Materials hit a major landmark figure, posting a record non-GAAP gross margin of 50% at the company level. To really put that into perspective for you, this is their highest gross margin in over 25 years. They've successfully clawed their way up from the 47% range we saw back in early 2024, expanding profitability in an industry that is notoriously capital-intensive. And diving a bit deeper into that Q2 report, the highlights are honestly staggering. We're looking at a record revenue of $7.91 billion. That's up 11% year over year. Record non-GAAP earnings per share came in at $2.86, an impressive 20% jump from the previous year. And as a huge signal of management's confidence, they bumped up their quarterly cash dividend by a solid 15%, marking their 9th consecutive year of dividend increases. According to their CFO, Brice Hill, this surge in profitability is largely being driven by value-based pricing on their really unique products, plus some serious ongoing manufacturing cost improvements. All of this builds a highly compelling long-term narrative. When we look at the historical data and the future projections, we're seeing a sustained margin expansion cycle. Management even went out of their way to raise their calendar 2026 semiconductor equipment growth outlook to more than 30%. I mean, when your end market customers have this kind of high visibility and, frankly, insatiable demand, that money trickles right down to the foundational infrastructure providers. Which brings us to Section 3, decoding the valuation models. Now, it's one thing for a company to post record earnings, but as focused learners, we always have to ask the hard question. Is all this massive growth already priced into the stock? Let's transition from the past and look at some forward-looking valuation metrics. What's genuinely surprising here is that despite posting their best margins in a quarter century, Applied Materials actually trades at a pretty significant discount compared to its peer group. Just look at the raw numbers. Their price-to-earnings ratio is sitting at 24.5. Compare that to an industry median of 35.7, which includes heavyweights like ASML and Lam Research. It's the same story with their enterprise value to EBITDA multiple. It's at 20.7, well below the industry median of 28.8. This valuation gap strongly suggests there's potential for multiple expansion as these operational efficiencies keep materializing. So let's put a hard number on this. Walking through an EV to EBITDA valuation model put together by the Oberlin Finance Club, the first thing that really stands out is just how conservative their assumptions are. They're only projecting a modest 9% revenue growth rate, and they use an EV/EBITDA multiple of 22, which again is still well below that industry median we just talked about. But even with these super conservative inputs, when they discount it back to the present, they arrive at a price target of $281.75. At the time of the report, that represented a nearly 21% upside. But what if we zoom out and take a much longer-term horizon? Ticker's mid-case valuation model presents a vastly more aggressive upside. They modeled a target price of $630, implying a massive 43% upside potential. Now, caveat here, this model requires a 10.8% compound annual growth rate in revenue all the way through 2035. And, crucially, it bakes in a PE multiple compression of 2.8% per year. Basically, what that means is for investors to actually realize that full total return by 2030, Applied Materials' earnings growth has to be incredibly powerful. Powerful enough to completely outpace the market, gradually derating the stock's premium over time. All right, Section 4, the bear case risks. Look, a complete explainer has to look at the data totally neutrally, from both sides. So let's pivot and take a hard look at the critical business risks that could quickly derail all this momentum. Right now, this is the core debate raging on Wall Street. The bull case is screaming that this is the ultimate foundational infrastructure play on the AI supercycle, and that management is making brilliant strategic long-term investments. But juxtapose that against the bear case. Despite that record revenue we just talked about, free cash flow actually experienced a dramatic 80% year-over-year decline. It dropped down to just $210 million in Q2. That huge drop is largely due to massive capital expenditures, spending $635 million in a heavy reinvestment period. The bears are arguing that burning cash at this kind of rate, in what is historically a very cyclical chip market, could be incredibly dangerous if overall demand unexpectedly softens. And on top of that, you have very specific geopolitical and operational bottlenecks to worry about. Currently, a full 24% of Applied Materials semiconductor systems and Applied Global Services revenue is coming straight from China. That level of concentration creates some serious regulatory exposure, especially amidst all the ongoing global trade tensions. Plus, management has explicitly come out and said that the global supply chain remains the primary binding constraint on their growth. Supplier lead times are stretched so thin right now that they are requiring 8-quarter forecasting windows just to execute. Imagine trying to predict your exact needs 2 full years in advance. If there's a hiccup anywhere in that 2-year planning cycle, the momentum could just abruptly halt. Which takes us to our last section, environmental and climate impact. For our final analytical layer today, we are moving beyond pure financials to explore the real-world physical risks outlined in their 2024 impact report. Looking directly at the materiality matrix from their impact report, it perfectly maps out exactly what issues are most critical to both the stakeholders and the business itself. Up there in the top right quadrant, the absolute highest priority area, you don't just see innovation in tech. You see climate change, greenhouse gas emissions, energy management, and supply chain resilience. The company openly recognizes that extreme weather and resource scarcity aren't just buzzwords. They are direct physical threats to their highly sensitive manufacturing operations. Breaking that down into literal threats, the company has identified some very specific geographical vulnerabilities. Think about it. Semiconductor manufacturing requires immense, mind-boggling amounts of pure water and perfectly controlled physical environments. Yet, Applied Materials' key sites are facing projected increases in extreme heat, severe drought, and intense storms, particularly in places like Southeast Asia and Israel. They're also actively modeling for increased flooding and wildfire exposure based on location. Geography literally creates vulnerability here, and water stress throughout the entire value chain is a localized reality that they have to actively manage every single day. So that brings us to our final thought. We've looked at the exploding total addressable market, the completely dominant market position in deposition, and those amazing record 50% margins. But we've also unpacked the massive capital expenditures driving down their free cash flow, the serious geopolitical exposure to China, and the literal physical climate risks that are threatening their fragile supply chain. So the question I want to leave you with today is this. Does Applied Materials' ultimate picks and shovels AI premium, combined with their discounted valuation relative to peers, actually justify taking on the immediate cash burn, the geopolitical headwinds, and the localized climate risks? Take all the data we've unpacked today, weigh both sides, and decide for yourself. Thanks so much for joining me on this explainer, and keep learning.